Welcome to Bloomberg Markets. I'm Scarlett Fu. The stock market falling on the first trading day of a seasonally weak month. This as investors face a wall of economic data. So here's a snapshot of today's trading action. You have the S&P 500 losing as much as 1.6%. So we're right around session lows. That is the biggest drop, by the way, since the sell-off on August 5th. And tech companies are leading the way. The Nasdaq 100 down 2.3%. 6 of the Mag 7 names losing at least 1% so far. We're also looking at copper. Lots of red clearly across the risk assets, but in the commodity space too. Copper retreating in London, off by more than 2%. Goldman Sachs slashing its price target on the metal by almost $5,000, and the reason is less demand from China. Oil also extending its recent weakness. You've got Brent falling below $75 a barrel, now at 74, touching the lowest since December of 2023. Now let's go back to equities overall and put the weakness that we're seeing right now into context. Abigail Doolittle has more. Abigail.
Yeah, because it's not just today in terms of Septembers that are bad. It's Septembers overall. This goes over the last 5 years. It's a seasonal look on a monthly basis. And you can see most months for the S&P 500 are higher. But February's have been one exception, down 1.7% overall. March is not so great. May down ever so slightly. Maybe that may sell in May and go away. But take a look at September, down 4.2% on an average basis, again, over the last 5 years. But going back past the last 5 years, there's Black Monday. Actually, that was August, speaking of August, but many, many other Septembers, very, very painful, whether it was 2018, 2015, 2011, a tough time. So we seem to be starting off in that line of thought. In fact, so much so that we now have the VIX going into backwardization, where you have the spot VIX, or the last time I looked at least, back above the VIX curve, and it's still true. So it should be the VIX here for the VIX spot VIX is 18.09 for the October contract, just a little bit below that. So it's not wide, but you can see this big move up going from 15 to 18. So investors getting a little bit nervous to the degree that they have been all along around the election time, October, November, and then out of the election. Just a little bit of extra hedging or maybe some outright bearish bets. As for what's weighing beneath the surface, let's take a look. So on top, these are the worst percentage movers for the S&P 500. Boeing down 7.8%, and of course they were downgraded by Wells Fargo to underweight from equal weight. The new price target basically 20% below where shares are now. That analyst highlighting the fact that a cash opportunity is basically going out the door. Free cash flow, this, according to this analyst, will peak in 2027. It's interesting. He must really be an axe on the stock, because you could have another analyst say this and the stock would not move that much. But plus, there's been a lot of bad news for Boeing over more than 5 years, so that could be a piece of this action too. Constellation Energy down 7.8%. Oil down towards 70, so down toward the bottom of the range over the last year. On the point side, Apple is one of the worst point decliners, down 2.2%, really a drag on the markets. And then the big one here is NVIDIA, down 7.8%. Scarlett, over the last 4 days since they've reported, this stock down more than 12%, the worst 4 days going back to 2022. And I would argue that while that quarter was good and the guide was good, it wasn't the blowout. So for a stock that into that report had been up 150%, too far, too fast. You have the yen strengthening a little bit. You have all these headwinds coming together, investors selling those shares, and technically it looks like it may just go back below $100 per share.
Yeah, investors had pushed the stock up expecting the best of everything, and they didn't quite get that. Bloomberg's Abigail Doolittle, thank you so much. Now, adding to the nervousness across markets, a raft of economic data due out this week. Today, we learned that U.S. manufacturing activity shrank for a 5th month. Evercore ISI's Julian Emmanuel saying a variety of factors are shaping the perception of this headline.
If you look at manufacturing, it has essentially been, as Mike said, in this sort of weakened state for the better part of a year now. And, you know, part of the benefit of China not growing as expected has been the cap on commodity prices, which is a significant tailwind for risk assets in general to a point. But again, there is this expectation that this, you know, you're not going to tip over because of China weakness. And we've seen it in the past. And that's part of where the Fed's calculus comes into play.
For more on the latest U.S. manufacturing data, let's bring in Stuart Paul from Bloomberg Economics. So, Stuart, I mentioned stocks open lower today, but we really saw the indexes take a leg lower, another leg lower at 10 a.m. when those ISM manufacturing numbers came out. Does this report revive the growth scare concerns?
I think it might. I think that beyond the growth scare concerns, there's a bit of a disinflationary impulse hiding in the details of the report. Most of the uptick in the report was driven by an increase in inventories and an improvement in supply chains. That should help to alleviate sort of pipeline price pressures and create a disinflationary impulse. That will be something the Fed is keeping in mind as it meets later in the month.
And disinflation is good for markets right now,
That's right.
Although this was a negative economic report overall. Manufacturing deeper into contraction. We mentioned 5 straight months below 50. How often does a manufacturing recession spill over into the broader economy?
It's typically just something that's indicative of broader economic activity. It's not necessarily the case that a contraction in the manufacturing sector spills out broadly into the economy. Manufacturing comprises about 10% of total GDP, a little bit higher in some select states, but they tend to be smaller states. But when you see weakness in consumer demand for finished products, that's indicative of what's going on in terms of just broader consumption growth. When you see consumption growth approaching zero, that's when you start entering that real recession risk phase.
Julian Emanuel mentioned a linkage to China. How does China play into these manufacturing numbers, if at all?
They're related in that they're both U.S. manufacturers and Chinese manufacturers are competing for input prices, despite the fact that there is some slowdown just globally and in the U.S. in manufacturing. We have seen, at least in the August data, actually an upside surprise in the prices paid in raw materials. Again, this is August data. We have to think on a forward-looking basis. The thing that probably matters most in a global context and across borders is that we see domestic demand weakness.
Right.
And so looking forward, we should see, again, some of that disinflation, some of that weakening pipeline price pressures.
Okay. You do see evidence that companies are holding off on spending, whether that's on hiring or whether that's on restocking inventory because of the upcoming election. Is that a component here that we need to think about?
I think that election uncertainty is part of it. I think that part of it is just weakness in the consumer outlook and weakness in demand. Firms are reporting that they are allowing for declining headcount, both through attrition and they're starting to lay off workers. That's specifically in manufacturing. We saw a reduction in hours worked, a reduction in both headcount and hours worked in both durables and non-durables manufacturing in July. We expect the same in August. As we think about the jobs report due out later this week, that's something that should contribute to what we think is going to be a relatively weak August payrolls print.
Yeah, okay, so jobs on Friday is obviously the big focal point everyone has, but we do have a number of jobs-related reports coming out. We've got JOLTS tomorrow, Challenger job cuts, and ADP on Thursday. What kind of movement have you seen on the non-farm payrolls number or the unemployment rate estimates from economists? Are they marking things down actively, or have the estimates held fairly steady?
Some of the estimates have been coming in. The estimate for job openings, for example, came in pretty notably. We're still marking job openings for July. JOLTS data are typically delayed. We're marking job openings for July at 8.2 million, so basically steady. When you look at the non-farm payrolls numbers, most of them have been coming in from about 170,000 as an early estimate, and they're starting to fall closer to 150, 145,000 jobs added in August. Unemployment rate forecasts typically, or for the most part, are staying steady around 4.2. Some folks are starting to get a bit more worried and are marking up their unemployment rate forecast for August to around 4.3%.
All right, fascinating. Thank you so much for giving us some insight into what we can expect this week. Bloomberg's Stuart Paul. Now, coming up on Bloomberg Markets, DirectTV and Disney battling for a new agreement after customers suddenly lost Disney programming, and of course that includes ABC and ESPN, over the weekend. That's coming up. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for our stock of the hour, which is Disney, whose shares are falling. It was down as much as 1.1%, but has come back a little bit here. A contract dispute over the weekend led DirectTV customers to lose access to ESPN, ABC, and other Disney programming. Bloomberg's Chris Palmieri has been covering this and joins us live now from Los Angeles. And Chris, one thing that we should note is that timing of this dispute is no accident. It's at the start of September, which is when football season begins, both college football and the NFL. And Disney kind of has a history of getting into contract disputes around this time of the year, doesn't it?
Yeah, if you remember a year ago, they got in a big fight with Charter, now the #1 cable company. It was a very similar thing about renewal of ABC and ESPN. And this time around, it's DirectTV, the third largest. We're talking about 11 million customers across the U.S. And, right at the start of football season and the U.S. Open, if you're a fan of that as well, they lost their channels.
Right, and the idea is that they have more leverage because this is when consumers really want to be watching that programming. What is the usual course of action here, and are events kind of lining up to follow the usual script?
Yes and no. Yes, in the sense that they all yell and say that this is an outrage, and there's no compromise here, and then in the end they compromise. But DirectTV had a call this morning for analysts, and they said, does this just mean you'll cave before Monday Night Football next week? And the CFO said, no. The CFO said this is an existential fight for us. This is over the future of our business. And what they're asking is they don't just want better rates and have to pay for fewer subscribers. They want the flexibility to offer packages that are sort of like streaming services. So there could be one just for kids and family programming, one for news junkies, one just for sports, and one for kind of general entertainment, and to have the ability to take these channels and put them together and offer them at lower prices to consumers.
So the idea is that people who don't want to watch sports don't have to pay for it because that's the costliest part of the package. Is Disney receptive to any of these smaller packages, smaller bundles?
Partly. They did offer, for example, a smaller sports package, but DirectTV said that there were other terms added to that, and they didn't get into specifics, but that just made it unusable for them. And to put this in context, the DirectTV folks said they pay Disney about $2 billion a year in subscriber fees. This is about $270 from each household that is a DirectTV customer every year, just going directly to Disney for all of those channels, ESPN, Disney Channel, ABC.
Yeah, to fund all those expensive live sports rights, which Disney, exactly. ESPN has no choice but to bid it because that is the reason for being. So when it comes down to it, for ESPN, a lot of it comes down to what happens with this part of the Disney empire and how it manages through all the cord cutting that's been ongoing consistently, even as it brings in a lot of cash flow. The president of ESPN, Jimmy Pitaro, recently laid out his strategy. Is there anything new to it? Did he say anything that you didn't already know?
Well, it is evolving, and for example, next year they're going to launch a standalone version of ESPN for streaming. This season they have this tool where you can find out where any game is on, whether it's on an ESPN platform or another network. They're making a big push into sports betting this year with ESPN Bet and integrating all the apps so you can get data for betting. So they're making a lot of changes in the business, and to get back to DirectTV, they say they're basically encouraging people to leave the traditional TV package with all of these other features that you can get online and get directly, and at the same time they're sort of starving in a way the traditional TV customer, not so much in sports because all of the big games are on ESPN, but in terms of the entertainment channels. So much goes direct to the streaming services nowadays.
Chris, final question to you. Any update on Venue, the sports JV that Disney was planning to launch with Fox and Warner Brothers Discovery? I know that a judge halted the launch, but is there any next steps that are being articulated here?
All three of the major partners, Fox, Warner Brothers, and Disney, say that they're going to continue to fight this. They didn't think the judge was fair in her decision, but it certainly seems, in this case, like DirectTV, seems to embolden the distributors to fight for their own version of Venue, essentially.
Okay, got it. Bloomberg's Chris Palmieri, who covers Disney and other entertainment companies out in LA for us. Thank you so much. Let's turn now to market makers in the headlines today, and we'll talk about two of the biggest, Citadel Securities and Jane Street. Both are on track for record annual revenue. Bloomberg has learned that at Ken Griffin Citadel Securities, first half net trading revenue rose 81% to just under $5 billion from the same period a year ago. While at Jane Street, net trading revenue gained a similar amount, 78% to $8.4 billion. For more on all of this, let's bring in now Bloomberg's Catherine Doherty. So, Catherine, Citadel Securities, Jane Street, these are not publicly traded companies. They are not obligated to disclose any of these numbers, right?
That's right. But they do have debt, and those credit investors are getting their results. They're getting updates. It doesn't have to be on such a strict schedule as if you are a public company having to disclose and tell your investors when you're going to disclose. But recently we've heard from Jane Street and Citadel Securities in the debt market. That's where these numbers are coming from. They're giving updates to their investors to provide some color on why they're seeing this record jump or the potential to reach a record for 2024. And they're citing both the volume in the equities and credit market. And for Jane Street in particular, they recently took out a loan in the market. That is why they're coming to credit investors. And they're saying that they're able to invest using that money that they got from the credit market to essentially help just not only continue the momentum, but to set a path that will potentially see growth that reaches and starts to compete with the major U.S. banks.
Okay, I'm glad you're going there, because to what extent are they taking market share from the major U.S. banks, or are they creating opportunities for themselves by offering expertise, access to nichier parts of the market?
So it's a combination of two things. Number one, the pie is getting bigger. So they're coming into this space and they're competing with the big U.S. banks. But because the pie is bigger, they're able to take market share. It's not necessarily that it has to be at the expense of the bank. But in the future, we will start to track to see whether the market share pulls back in a significant way from some of these big public U.S. trading firms. And if the market makers are providing the expertise that you allude to, that is in the form of their technology that's able to provide better pricing, tight pricing, and also their people that they're taking from sometimes it is from the U.S. banks. Other times they're coming from hedge funds. They're providing expertise in the form of fixed income and equities trading. For Jane Street, they're very dominant in the ETF trading space.
That's right.
So their people and their technology is really their bread and butter, and where they're putting money so that they can not just maintain this growth, but really accelerate into the future.
Very quick question for you. What's been the trajectory of their growth? If you were to kind of plot it out over time, has it been gradual, or has it suddenly gone higher?
So last year, across the market, this wasn't just with the market makers. You saw a pullback in trading from 2022 and 2021. Both of those years were record hauls. 2024 is likely to be kind of a continued or renewed momentum that we've seen at the U.S. banks, and now that we're seeing with the market making firms. But their jump, the 81%, the 78% compared to a year ago that we're citing in our reporting at Citadel Securities and at Jane Street, that is a just monumental jump when you compare it to the U.S. banks that are still growing, but not at that over 50% rate.
Yeah, much more moderate rates, in other words.
Exactly.
Catherine Doherty, thank you as always. Bloomberg's Catherine Doherty. Now, coming up, we've got one of China's biggest internet companies securing a big endorsement from the country's antitrust watchdog. Stay tuned for my conversation with Kuo Zhang. He is president of Alibaba.com. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. China e-commerce giant Alibaba overcoming a regulatory hurdle. Beijing's antitrust watchdog agency cleared the company of monopolistic behavior after a probe into its online behavior overall. For more on this, Kuo Zhang, president of Alibaba.com, joins us now. So, Kuo, investors clearly like the news of the watchdog clearing Alibaba after this 3-year investigation. What does the endorsement mean for your business, the B2B business of Alibaba?
Sure. Actually, B2B, is the first business of Alibaba Group, and we are focusing on B2B. The first for B2B, global trade actually is a big business. It's $20 trillion, and the digital penetration we think is still low. It's kind of a single digit. Second is that we are the top platform the top B2B platform if you want to build your own business, create your own product, and start your own brand. I can give you some examples if you have interest.
Well, I want to talk about the overall economic backdrop here, too, because it's important to see Alibaba as kind of representative of what a lot of companies in China are struggling with, this post-COVID slowdown and consumers not spending as much money as they used to. What is the growth story right now at Alibaba.com? Where is the growth going to come from?
Sure. So we are part of the business of AIDC, which is the global business part of Alibaba Group. And in this quarterly release, AIDC actually is more than 30% of growth in revenue. And Alibaba.com, the B2B part, we are more than digital, two-digital growth is 12% of growth for the last quarter. And first of all, if you see from the kind of global business, we see the global business is growing, is fast, especially for the digital part. We are using all kinds of technology to enable that. And the second, from the kind of customer perspective, we see there's a lot of kind of customers going global. It's not only from China, but from all over the world as well. So we see many of the kind of areas that is a 30 or 40% of growth from the new customers' perspective.
All right. Kuo, I really appreciate your joining us. Kuo Zhang is president of Alibaba.com. He's speaking to us from Las Vegas. And as we head to break, just a quick mention here of U.S. equity indexes at session lows right now, with the Russell 2000 faring the worst, declining by 2.7%. The S&P 500 as a whole in a 1.6% hole. This is Bloomberg.